Sometime between Sunday and Monday, Randy, he's the host of what used to be Brick Talk. It's a financial conversation to empower ordinary people. This was held on Twitter or X every Friday evening. Now, he made a statement, and a number of persons have been debating with him about this APO versus rights issue. He is contending that a rights issue gives a great advantage to shareholders, and the APO can result in dilution, and that is a fact. Let me just break it down, starting with preemptive rights, and then I'm going to go to APOs and rights issues. I don't know if any of my former UE MS-28, these students are following me here, but the teacher in me kicked in when I looked at this debate. Now, common shareholders often have the right called preemptive right to purchase any additional shares sold by a company. In some areas, the preemptive rights are automatically included in every corporate articles of association. When the company is being incorporated, it has to present its memorandum of association, articles of association, etc. Now, in others, it may be necessary to insert it specifically into the articles or charter. The purpose of the preemptive rights is twofold. First, it protects the power of control of current stockholders. If it were not for this safeguard, the management of a company under criticism from stockholders could prevent them from removing it by issuing a large number of additional shares and purchasing these shares itself. Management could secure control of the company and frustrate the will of current shareholders. The second and by far the most important reason for the preemptive right is that it protects shareholders against a dilution of value. For example, suppose 1,000 shares of common stock, each with a price of $100, were outstanding, making the total market value of the company $100,000. If an additional 1,000 shares were sold at $50 a share or for $50,000, this could raise the total market value of the company to $150,000. When the total market value is divided by the new total shares outstanding, a value of $75 a share is obtained. The old stockholders lose $25 per share, and the new stockholders have an instant profit of $25 per share. Thus, selling the common stock at a price below the market value would dilute its price and would transfer wealth from the present shareholders to those who were allowed to purchase the new shares. The preemptive right prevents such occurrences. So preemptive rights really serve to protect existing shareholders. Now, an APO or additional public offering and a rights issue are both methods that companies use to raise capital by issuing new shares, but they differ in their approach and their targeted investors. For the APO, additional public offering, when a publicly traded company issues new shares to the general public after its initial public offering, its IPO, these shares can be sold to a new investor, institutional investors, or existing shareholders, depending on the company's strategy. So what are the key characteristics? This is open to both existing and new investors, the APO. This can dilute existing shareholders' ownership unless they buy additional shares. The APO is often used to raise capital for expansion, debt repayment, or acquisition. And I want to make the point here, whether you studied POB, you did a BBA, an associate degree, an MBA, or a doctoral degree in finance, you must know that a private company's profit motive reigns supreme. The CEO, CFO, C-suite executives have to give account to shareholders. So the bottom line is generally the profit motive. You are in business for a profit, you're not a charity. Moving right along. A rights issue is when a company offers existing shareholders the right to purchase additional shares, usually at a discounted price in proportion to their current stock holdings or shareholdings. This method allows shareholders to maintain their ownership percentage of the company. So what are the key characteristics of a rights issue? These are offered exclusively to existing shareholders. They are typically priced lower than market value to encourage participation. They can be renounceable or transferable, or they can be non-renounceable. They must be exercised by the shareholder or the opportunity is lost. Preemptive rights refer to the legal rights of existing shareholders to purchase new shares before they are offered to the public. I need to reiterate this. This protects shareholders from dilution of their ownership stake when new shares are issued. In a rights issue, preemptive rights are exercised because existing shareholders get the first opportunity to buy new shares. In an APO, additional public offering, new shares may be offered to the public without giving existing shareholders the right to maintain their proportionate ownership, leading to potential dilution. And I explained that at the beginning. Now, what are the features of each? The target investors for the APO, general public, including new investors. For the rights issue, existing shareholders only. Pricing. For the APO, market price or a slight discount. For the rights issue, discounted price. Ownership dilution. For the APO, existing shareholders may be diluted, the value of their shares. All right. The rights issue, shareholders can maintain ownership by exercising their rights. What about preemptive rights in relation to APOs? Not necessarily granted in an APO. For the rights issue, it's granted to existing shareholders. An additional public offering, an APO, occurs when a publicly traded company like those that are traded on the Jamaica Stock Exchange, NYSE, etc., they issue new shares to raise additional capital. These are two main types. You have the dilutive APO, where the company issues new shares, which increases the total number of shares outstanding and may dilute existing shareholders' ownership. You have the non-dilutive APOs, where existing shareholders, such as insiders or early investors, sell their shares, meaning no new shares are issued and ownership percentage remains the same. What are the advantages of an APO? Access to additional capital. Companies can raise funds for expansion, debt reduction, acquisition, or other strategic initiatives. And you have different ways to raise capital, including debt, meaning the company can borrow money. The company may realize that if they are going to borrow money, the interest cost on the debt is going to be too high for them, so they may decide that they are going to do an APO. And you know that with common stock or common shares or ordinary shares, the dividends are paid on the discretion of directors. So they have more leg room, more flexibility, and a lower cost of capital. Moving right along. The advantages of an APO. Access to additional capital. Companies can raise funds for expansion, debt reduction, acquisition, or other strategic initiatives. Lower risk compared to an IPO. And the IPO is the initial public offering when the shares are just being offered for the first time to the market. The company will issue a prospectus. You look at what their plans are. You look at their performance. You look at their projections, and you determine if you want to buy those shares. So that's the IPO in a nutshell. Since the company is already public, investors in the APO have more information to assess its performance, and this reduces uncertainty. But you must be informed. You must read the fine print. There is potential for favorable pricing. If the company's stock price is performing well, an APO can raise capital at a higher valuation, so they can sell the stock for more. Stronger investor confidence. A well-received APO can signal market confidence in the company's growth and financial health, and that can affect stock prices, trading prices. I will do some ratio analysis discussion some other time, but for right now, I just want you to understand the arguments. There is increased liquidity. More shares in the market can improve stock liquidity, making it easier for investors to buy and sell shares. You realize that most of these advantages are in favor of the company, right? Moving right along. Disadvantages of an APO. Dilution of existing shareholders. In dilutive APOs, issuing new shares reduces the ownership percentage of existing shareholders, potentially lowering their earning per share, their EPS. And I said I'm going to do an analysis of the balance sheet so you can understand these terms, the EPS and all of that. Stock price volatility. Investors may perceive an APO as a sign that the company is struggling to generate cash internally, leading to a drop in stock price. There is also the disadvantage of market dependence. If market conditions are unfavorable, the offering might not attract enough buyers or may require selling shares at a discount. Regulation and administrative costs. Although generally lower than an IPO, an APO still involves legal, regulatory, and underwriting costs. Another disadvantage, potential negative investor perception. Frequent APOs may signal that the company is overly reliant on external funding rather than organic growth. Let's look at a comparison of APOs versus other capital raising methods like a debt offering or a rights issue. For the APO, it's really issuing new shares to raise capital after an IPO. For the debt offering, meaning that you're going to borrow money, you're issuing bonds or other debt instruments to borrow money. For the rights issue, you're offering new shares to existing shareholders, often at a discount. How does the dilution occur in each of them? There is dilution in the event of an APO. For the debt offering, no dilution. For the rights issue, yes, there's likely to be dilution. For the APO, it's equity. For the bond, etc., debt. Rights issue, equity. For the repayment required, for the APO, no. For the rights issue, no. But you can expect dividend. Hopefully, it is a growth stock so that you will be kind of happy with the dividends that you receive. For the debt offering, yes, with interest. The investor base, for the APO, public investors. For the debt, bond investors, lenders. For the rights issue, existing shareholders. Impact on stock price, very important. For the APO, it may decrease. The stock price may decrease due to dilution. For the debt offering, what is likely to happen? It is usually minimal unless excessive debt is taken on by the company. So you're borrowing a lot of money, then shareholders are going to be kind of wary and wondering what's happening here. For the rights issue, it may decrease the share price due to discount pricing, but if the company is performing well, if fundamentals are strong, then the stock price is likely to go back up. And hopefully the market conditions are right as well. What about the cost? Costs are moderate for the APO because you're not issuing an IPO and prospectus and all of that. Again, legal, underwriting, regulatory costs and all of that, you minimize those costs. For the debt, it's lower than equity, but it requires interest payments. For the rights issue, lower than an APO, but still involves legal and admin costs. What about the regulatory burden for each? For the APO, yes, you have to file and disclose with the relevant regulators. For the debt offering, it requires credit ratings, bond issuance process, etc. And you would hear about, for example, the bond rating and the rating agencies, Standard & Poor's, etc. And the rating that is accorded to that particular debt. For the rights issue, regulatory burden requires shareholders to communicate and approve. It's minimal. When is it normally used? For the APO, in the case of expansion, acquisition, maybe you're purchasing other companies. Or for debt repayment, you can offer an APO also. What about for the debt offering, the use case? For large projects, stable companies will take on new projects and they may need funds, large volumes of funds, and need it quickly, so they may take on the debt instead of going the APO route. All right, for the rights issue, the use case, strengthening shareholder control, additional capital infusion. Now we're going to look at the advantages and the disadvantages. Advantages of the APO: raises equity capital without adding debt burden, can improve stock liquidity, no fixed repayment obligation. Disadvantage: dilutes ownership of existing shareholders. Stock price may drop due to perceived over-reliance on external funding. Market conditions affect the success of the offering. What about the debt offering? If you go the bond route or to borrow the money, take a loan. The advantage: no dilution of shareholders' equity. Interest payments are tax deductible, and you have predictable repayment terms in terms of, what interest you're going to be paying. Hopefully, this is going to be on fixed terms. What are the disadvantages? Adds financial leverage, increases company's debt burden if you borrow. It requires regular interest payments regardless of company performance. Credit rating affects borrowing terms and cost of capital. What about the rights issue? What are the advantages? It gives existing shareholders priority, preventing outside dilution. Shares are often offered at a discount, increasing participation. It can be cheaper and faster to raise funds than an APO because the regulatory burden is not there. Disadvantage, it still dilutes ownership if shareholders don't participate. Discounted share prices may negatively impact stock value. It requires shareholders' approval and communication efforts. You have to communicate effectively. So which one should you choose? You may think about an APO if the company wants to raise significant capital without increasing debt, but is okay with some dilution. What about the debt offering? It's ideal for companies with stable cash flows that can handle debt repayments while maintaining ownership control. So the project you are taking on must bring the kind of cash flow that makes the debt payments, your loan payments, manageable and still leave you in a good, strong financial position. The rights issue suitable for companies wanting to raise funds while keeping ownership within existing shareholders, though at a discount. So you may ask the question, which of these would be most suitable for a company? And my answer would be it all depends. Let's take a tech company, for example, that recently went public through an IPO. They may want to expand into new international markets and invest in research and development. Instead of taking on debt, it may issue an APO to raise an additional $500 million. While existing shareholders face dilution, the long-term growth potential for this tech company may outweigh the downside. When an APO, there's no repayment obligation. Of course, the dividends are expected, but there is no obligation for a fixed repayment in terms of interest cost. It also allows a company to raise a large sum of money without increasing debt, increasing your leverage. Investors may also see the expansion as a positive signal. The debt offering, if you're going to go the route of issuing bonds or borrowing money, taking out a loan, and a bond is really just a long-term debt instrument that has certain features, yield to maturity, coupon payments, etc. I did a presentation on that already. The debt offering is best for companies with strong cash flow. Let's take a utility company. They may need $1 billion to build a new power plant, but they may have steady revenues from customer billings, payments of bills. The company may issue corporate bonds at, let's say, a 5% interest rate. This predictable cash flow allows it to repay bondholders without affecting shareholder ownership, so no dilution really takes place here. Why would they go the debt route, a company like this? No dilution of existing shareholders take place. Interest payments are tax deductible, so you can write it off against your taxes. And the company can secure long-term, low-interest financing. What about a rights issue, you may ask? This is best for strengthening shareholder control. For example, a family-owned manufacturing company may need $200 million to upgrade its equipment. The owners may not want external investors to gain control, so they may offer a rights issue at a 20% discount, allowing existing shareholders to buy additional shares first. Why a rights issue? It ensures existing shareholders maintain control, as I've said before. It helps to raise capital without seeking external investors. I can talk about hostile takeovers, but that's for another session. Discounted price encourages participation because you're getting the share at a discount. What are the key takeaways from what I've shared with you so far? You choose an APO, an additional public offer, if you need significant funding, you don't want debt, and you can handle some dilution. You choose debt, meaning you're going to issue a bond or you're going to borrow money if you have reliable revenue to cover interest payments and want to avoid dilution. You choose a rights issue if you want to keep ownership concentrated among existing shareholders. And we're going to look at some of the companies that actually offered APOs to the market. NCB, and I stand to be corrected if there's anybody with any additional information. I am open to receiving it. But from my memory, NCBFG Group, they launched an APO of new ordinary shares in April 2024, and I think it was 78.5 million new shares they offered with the option to increase to 117.75 million. Derrimon Trading Company, they announced an APO of ordinary shares in August 2020. Pulse Investment, they approved an APO in 2019. The JMMB Group Limited, they announced plans for an APO in 2018. 138 Student Living Jamaica, they approved resolution to facilitate an APO in 2023. Fosrich Company Limited, they considered an APO as part of their capital raising strategies in 2022. Now, these APOs really allow companies to offer additional shares to the public and enable them to raise funds for various purposes such as expansion, debt reduction, or other corporate initiatives. Companies, when you look at cost of capital, you may have equity, you may have debt, and other elements in your capital structure. You may want to reduce your level of debt, so you may decide that, all right, we are going to increase the equity part of our cost of capital so that, yes, we pay dividends when the directors see it so fit. And remember that dividends don't have to be paid. The company can plug back the profits into the business for expansion and pay dividends later on. Unless, of course, you have preference shares where you know that the dividends are usually fixed, but then preference shareholders don't have voting rights and all of that. I covered that in another session. So you have all of these companies that have issued APOs. You can take the time to look at their performance and you can determine what you believe would be better, whether a rights issue or an APO. But what Randy was saying really is that an APO that is well structured and beneficial to all shareholders is one that respects all current shareholders' preemptive rights. It's called a rights issue. That's what he said verbatim. In other words, a rights issue puts existing shareholders in a better position than an APO because of the advantage they have to exercise their preemptive rights, which I explained at the beginning of this presentation, to purchase new shares before they are offered to the public. Have a beautiful day. Your questions are welcome. I promise you I'll give you a little bit more on finance as the weeks go by.